All right, so what we're going to do in this section is look at tax intricacies. So some interesting things that happen when you kind of examine the income tax and sales tax and all that kind of good stuff. All right, so let's start by saying a single person makes $40,000 and has $8,000 in tax credits. Okay, so single person making $40,000, go to your single tax bracket, 40,000 minus, that puts them in the 36,900 and above category. So by the way, that is, we should write this down, 40,000 minus 36,900 is equal to 3,100. So in your taxes, you should 5081.25 plus 25% of 3,100. Didn't write that very well, but so 5081.25 plus 25% of 3,100, and that comes out that your tax burden for a $40,000 person is going to be $5,856.25, right? Now that's before tax credits are applied. So here's the trick. It turns out we have more tax credits than we actually do tax. And there's two options that you could have. So this one, again, is before credits. The two options, option A is that you actually get the whole 8,000, all right? And that means that my tax would be negative $2,143.75. Okay, in other words, the government would owe me $2,143.75. The other option is that you pay it off until you get to zero, and the government's not going to owe you anything. Okay, and that extra $2,143.75 is basically considered zero to the government. Okay? So what I was describing is basically the difference between refundable and non-refundable tax credits. So refundable was the case where we got the negative 2143.75. In other words, refundable tax credits, actually you get back no matter what. So if I had $8,000 tax credits and it was all refundable tax credits, then you get back $2,000. Now, non-refundable, you only get up to the amount you owe. And when I say the amount you owe, I'm talking about the tax burden. I'm not talking about, what you're getting back in your income tax return. I'm just talking about how much you owed in taxes. All right, so this is sort of a before we apply the income tax return stuff. Okay, we understood that in the income tax return, you get back, it's a balancing mechanism. So this is before you talk about the income tax returns. So refundable tax credits, you get back no matter what. Non-refundable, you only get up to the amount you owe. So you would have gotten back $2,143.75. You would have been owed that in taxes if it was refundable. Non-refundable, you would have gotten zero. And by the way, I'm just hitting on this. This is just one of many types of things that like this that happen. And you can talk about what would have happened if we'd had $3,000 worth of refundable and mixed and matched, And I don't want you to get into that thick into the woods, but you should know the difference between refundable and non-refundable tax credits. Now, another thing that's interesting about taxes, anytime you're talking about taxes, the percentage you use is interesting. So your percentage on income taxes, we could have calculated it with gross or net income. We'll talk about what those things are in just a second. The federal government always calculates percentage on gross income. That is the income before we talk about taxes. The net income is the income after you've paid your taxes. So let's take an example. So if you make $50,000 and you're a single person, then you pay $8,356.25 in taxes. Okay. Now, your gross income is the $50,000. All right, so your gross income is $50,000. That's the income before you apply your taxes. Your net income is $41,643.75. In other words, it's the $50,000 minus the $8,356.25. So gross is the amount before a tax is applied, and net is the amount after. And oftentimes we want to talk about net incomes of people because, well, that's how much you have to spend on goods after taxes, right? It's no use talking about $50,000 because we don't have $50,000 to spend. We only have $41,643 to spend. So a lot of times, more important is talking about the net income rather than gross. Now, we're going to find the percentage of taxes out of the gross and the net income. So, again, this is the same example. And let me just write what we had before, just to remind you. We had $8,356.25. That was my taxes. And $50,000 was my gross income. So, if I want to find the percentage of taxes out of the gross income, I take that $8,356.25, divide it by 50,000, and then to get a percent, you multiply or move the decimal over or multiply by 100. 8,356.25, divide that by 50,000. So you got 16.7125, and I'll, like I always do, round that. So 16.71%. Now, out of the net income, we have 8356.25 out of 41,643.75 times 100. So 8356.25 divided by, type this into your calculator. And you will find out that that comes out to 20.07%. Okay? So when you talk about tax rates, the government will talk about gross income. But when you talk about tax rates of out of net income, well, the percentages actually increase. By the way, this is known as the tax inclusive versus the tax exclusive rates. Okay? Tax inclusive is based on amounts with taxes included. So basically you're dividing by the number with taxes. So that's the idea behind that. Divide by the number with taxes. In other words, in our income tax case, that would have been the gross income. Exclusive is without the taxes. So tax excluded. Without tax. That looks bad. Alright. So inclusive is basically out of the gross. Exclusive is out of the net. Now, the reason we don't want to use gross rate and net rates is because in other situations, we might not be talking about the income tax. We might be talking about a sales tax or some other types of taxes. But basically, tax inclusive means we base it on with the taxes. Tax exclusive is without the taxes. Alright, so let's do another example of this and let's see how this works. Let's pretend somebody makes $64,500 and pays $10,965 in taxes. Okay? So, gross income is going to be that $64,500. $64,500. When I take out the taxes, that gives me a net income of $53,535. So let's do tax inclusive rate and the inclusive tax rate and the exclusive tax rate. To get the inclusive, we're taking the 10,965 out of 64,500. So 10,965 divided by 64,500. Multiply it times 100 to get a tax inclusive rate or inclusive tax rate of 17.00%. So it's actually a perfect 17%. To get the tax exclusive rate, we're going to take 10,965, divide it by 53,535. That's my net income. Always multiply by 100. And once you type that in, you should get 20.48%. All right. So again, if we're talking about exclusive tax rates, it's much, much higher. Now here's where the weird trick comes in. Let's switch over to, instead of the income tax, let's switch over to the sales tax. So if you buy $100 worth of goods at a store and pay $108 at checkout. Now notice the 108, that is with taxes included, right? Now clearly there's $8 worth of taxes here. Maybe I should have said that explicitly, but there's $8. We went from 100 to 108. So the inclusive tax rate is 8 out of 108. Multiply that times 100. The exclusive tax rate, this is without taxes. So this is excluded, this 100. So it's going to be 8 out of 100 times 100, right? So the exclusive tax rate is actually 8% exactly. The inclusive tax rate is 7.41%. By the way, this still matches up. I hope you noticed that inclusive tax rate has always been smaller than the exclusive. Now, here's why I say it's kind of a bit of a conundrum, because when we were reporting the income tax rate, we were reporting it as an inclusive rate. So on our last example, it came up to 17%. That's the percentage that the government would use to include income taxes. Sales tax rate, well, sales tax rate is actually an exclusive rate, at least the one that they report. Okay? And so basically, what this has the effect of doing is it has the effect of making sales tax rates seem higher than what they would be if they were income taxes, and income tax rates seem lower than what they would be if they were computed as sales taxes. So it's a kind of an intricacy of our tax system that income tax is always reported as inclusive, while sales tax is always reported as exclusive. Now, there's a modern day example of how this actually plays out. There's something called a fair tax, or fair tax websites, or all these kind of things. And so what they've done is they've suggested, instead of having an income tax, let's replace it. Let's get rid of the whole income tax system and replace it with a federal sales tax. Okay? Now, again, I'm not going to say to be for this or to be against this, but what I want you to think about is that when you replace an income tax with a sales tax rate, oftentimes people get a little worried because, specifically, the sales tax rate looks really large at the beginning. So let's check this out. All right, so basically what would happen on a fair tax is you would buy $77 worth of goods. You'd pay $33. That would make your total at checkout to be $100. So with taxes included, oh, you know what? I just totally, whoops. That should not be a 3. Excuse me. So there's an error on this slide. 77 plus 33 does not add to 100. Actually, 23 plus 77 adds to 100. So the error was mine. Basically, you're going to buy $77 worth of goods, $23 where you would pay extra in taxes. So if you include taxes, the inclusive tax rate is 23%. Okay? If you look at the exclusive tax rate, 23 out of 77, well, that's 29.87%. All right? So, again, I'm not advocating for or against the fair tax. You can decide for yourself. It's an interesting idea, but again, you can decide for yourself whether that's a good or bad thing to replace the federal income tax code with a sales tax. And I'm very much oversimplifying it. There's all kinds of things. You get stipends in the fair tax system every month, rather than getting a check in the mail right? Rather than having to fill out an income tax return, you get a stipend at the end of every month. But more to the point, just this idea that oftentimes people will criticize the fair tax and say, well, they've added a almost 30% sales tax. Well, they kind of did, but remember that's replacing an income tax. And so as an income tax, it would look like a 23% tax. All right? Again, I want to be fair to both sides here, so you can look more of those things up if you want. All right? My point is to be able to understand the inclusive versus the exclusive tax rate.